In 1966, the Dow Jones hit 800. 16 years later, in 1982, it was still at 800. 16 years. Zero return. And in real terms? Investors lost 3/4 of their money. This is the story of how inflation murdered a generation of investors, and how a few quiet ones got rich. I've watched this movie before. Inflation hits 4%, then 6%, then 9%. Everyone says it's transitory. Then it isn't. By March of 1980, U.S. inflation peaked at 14.8%. Gas lines wrapped around city blocks. Mortgage rates hit 18%. And most investors did exactly the wrong thing. But a small group, Buffett, Munger, Templeton, they didn't just survive. They got wealthier. Today I'll show you their playbook, and the third lesson is the one that still works in 2026. For 30 years after World War II, investing felt simple. Buy bonds, collect coupons, retire comfortable. Then the 1970s arrived, and rewrote the rulebook. Nixon took the dollar off gold in August 1971. The OPEC oil embargo hit in October 1973. Oil quadrupled from $3 a barrel to $12. Then the Iranian Revolution in 1979 doubled it again to $35. The result? Stagflation. High inflation. High unemployment. No growth. Economists said it couldn't happen. It did. And the standard 60-40 portfolio? Annihilated. Long-term treasury bonds earned the nickname, certificates of confiscation. Because every coupon you collected was worth less than the last one. Here's what most investors missed. Inflation isn't just a number, it's a thief that picks every pocket in the market. But it doesn't pick them equally. And that's where it gets really interesting. In 1977, Warren Buffett wrote one of the most important essays in investing history. It was called How Inflation Swindles the Equity Investor. Published in Fortune magazine. And the insight was brutal. Buffett pointed out that most companies are like savings bonds in disguise. They earn roughly 12% on equity. That's their return. So when inflation runs at 13%, shareholders are running backwards. Every dollar of earnings buys less than the dollar invested. But it gets worse for capital-intensive businesses. Think steel mills. Auto plants. Utilities. To stay in business, they have to replace their factories at new, higher prices. So even when reported earnings looked fine, real earnings were a fiction. U.S. Steel, Bethlehem Steel, the great industrial giants, their stocks went nowhere for a decade and then collapsed. So which businesses survived? Buffett's answer was simple. Find companies that can raise prices faster than their costs go up, without needing to spend more capital to do it. That's a pricing power business. That's a moat. And in the 70s, that distinction was the difference between getting rich and going broke. Now let me show you what Buffett actually did with this idea. While everyone else was buying gold or panicking out of stocks, he was quietly building positions in 3 legendary businesses. In 1972, Berkshire bought See's Candies for $25 million. A boring candy company. But here's the magic: See's could raise prices every year without losing customers. People paid up because See's was a gift, an emotion, not a commodity. Over the next 50 years, See's generated over $2 billion in pre-tax earnings on that $25 million purchase. In 1973, with the market crashing and the Watergate scandal raging, Buffett bought the Washington Post for $11 million. The market valued the whole company at $80 million. He calculated intrinsic value at $400 million. By 2000, that stake was worth over $1 billion. A nearly 100-fold gain. And in 1976, he rescued Geico from near bankruptcy at $4.20 per share. He understood the insurance moat. Today Geico is a foundational pillar of Berkshire, generating tens of billions in float. The pattern? Buy great businesses. With pricing power. When everyone else is selling because of macro fear. The 70s didn't change his strategy. The 70s confirmed it. But there's one more lesson the 70s taught, and most people still get it wrong today. Gold was the obvious play. From $35 an ounce in 1971 to a peak of $850 in January 1980. A 24-bagger. Sounds amazing, right? Until you look at what happened next. By 1985, gold had collapsed below $300. And it didn't recover its 1980 peak in nominal terms until 2007. 27 years of waiting. In real terms? Even longer. Meanwhile, the investor who bought a basket of high-quality American businesses in 1980 when everyone said stocks were dead, when Businessweek ran the famous Death of Equities cover, earned roughly 15% annualized for the next 20 years. The contrarian play wasn't gold. It was buying productive assets when the world hated them. Then came Paul Volcker. Appointed Fed chair in 1979. He did the unthinkable, he raised the federal funds rate to 20% by June of 1981. It triggered a brutal recession. Unemployment hit 10.8%. But it also broke the back of inflation. And it set up the greatest bull market in American history. Here's the principle the 70s burned into every great investor. Inflation doesn't reward speculation. It rewards ownership. Of real businesses. With real pricing power. Run by people who don't need to keep raising capital just to stand still. Gold flashed. Bonds bled. Industrial giants stagnated. But quiet, boring, capital-light businesses with strong moats, they didn't just survive. They quietly compounded their owners into wealth. The next inflation cycle is coming, they always do. And when it does, the question won't be which clever asset class you bought. It'll be, did you own businesses that could raise their prices faster than their costs? That is the entire game. So tell me in the comments, what's one company you own right now that could raise its prices 10% tomorrow without losing customers? That's your inflation hedge hiding in plain sight. If this changed how you think about inflation, hit subscribe. We publish one of these every single day. Tomorrow we're tackling the question Buffett asks before he buys any business, and most investors never even think to ask it.